We spoke earlier of how to compute your capital gains on sale of property correctly so you do not pay more tax than what is necessary. The question then becomes, how much tax would you actually pay? The tax you pay is a function of two things: A, the tax rate, and B, the size of your taxable gain. First off, tax rate. This tax rate depends on how long you've owned it. If it is for less than 2 years, meaning short term, you shall pay the short term capital gains tax. However, if it is for more than 2 years, you pay the long term capital gains tax. Now, the short term tax depends on your tax bracket for the financial year. But remember, tax will be deducted at source at the time of sale. For non-resident Indians, the TDS is deducted at the rate of 30% of the sale price. The tax you eventually pay will be on the basis of income tax returns you file for the financial year. If the TDS amount is higher than your tax liability, you will get a tax refund after filing your taxes. But if you want to avoid the refund process, apply for a certificate for TDS at a lower rate before executing the sale. The income tax officer will determine the TDS on capital gains and issue the certificate in, let's say, 30 working days, based on which the buyer will deduct lower TDS at agreed rates. You must differentiate between the taxes eventually payable and the TDS at the time of sale itself. Now that was short term. How about the long term capital gains tax? Long term capital gains tax is a standard 20% on the taxable gain, but you pay a surcharge plus cess, education cess, and health cess based on the sale price of the property. For property between 50 lakh rupees and 1 crore, you pay 10% surcharge and 4% health and education cess. It takes the effective TDS rate to 22.88%. In this manner, for properties between 1 crore rupees and 2 crore, the total rate is 23.92%. Similarly, for properties between 2 and 5 crore, it is 25%. Those above 5 crore, 37%. Surcharge and education cess can vary from time to time. Surcharge rate increases with the rise in the property value, which in turn raises the overall TDS rates. Hope you got a good idea of taxes on sale of property. Going ahead, there are ways to save on taxes which mainly involve reinvesting the gain in residential property or buying certain bonds, which we shall speak of another time. In summary, the short-term capital gains can be high if your income tax slab is high. Therefore, plan the sale at least after 2 years of holding it to come under the long-term capital gains, not short-term. Thank you for your time. Hope this was useful. If you have any questions, send us an email. Our address is questions@nrinotebook.com. Again, that is questions@nrinotebook.com. See you soon.